There is often a strong tie between certain commodities and specific currencies, so it has long been a practice of professional Forex traders to closely follow these markets. The US dollar has a more general tie to both gold and oil. Gold because it's attractive to investors when the US dollar is down, and oil because the US is one of the world's largest oil importers. Now, the top three currencies affected by commodities are known as the COMDOLs: the Canadian dollar, the Australian dollar, and the New Zealand dollar. The Canadian dollar has a close correlation to the oil market because oil is the country's largest export. They are also the largest supplier of oil to the United States. To show this correlation on a chart, let's go ahead and look at the crude oil market here, a 4-hour crude oil market. Now, in this chart, what I've done is I've actually I've changed the Canadian dollar to the first currency in this pair. Normally, you would see this as an inverse relationship because of the U.S. dollar. Normally, the pair is the USD CAD. So since I put the CAD first, that's what you're seeing here. So, and I did that just to illustrate the correlation here with the oil market being the candles and the Canadian dollar being the bars. And recently we've seen a seriously large decline in oil, and it's had a very large effect on the Canadian dollar as well, this pair overall. Here is the daily chart, and you can see from the daily chart the very close correlation between the Canadian dollar and oil. Similar to the Canadian dollar and oil, the Australian dollar has a close tie to the gold market, since Australia is the world's third largest producer of gold. In this example, you can see the gold market, which are the candles, and the Australian dollar being the bars. Okay, so you can see that the close correlation between gold and the Australian dollar. These are just a couple of examples of how analyzing the commodities market can also help you determine the most probable scenario for some of these currency pairs.